Hello everyone and welcome back. Today's topic is venture capital and private equity. These are two of the major players in the entrepreneurial finance setting. So if you have a startup and you are looking for funding, usually venture capitalists and private equity firms are players you want to talk to. So let's start with some definition. So private equity is an asset class of equity securities. So you might remember from the first classes, we defined debt and equity. Usually private equity and venture capital firms provide equity. In some cases, they also provide debt, but most of the time they want to invest and buy equity in the firm so that they can take advantage of potential growth. In some cases, they also buy convertible debt, which is in between debt and equity, which means you have a debt that in the future can be converted into equity. When we talk about private equity firms, there are different definitions. The broad definition includes private equity, venture capital, and angel investors, because as the word suggests, they buy equity in private firms. But usually, we adopt a narrower definition, in which case, when we talk about private equity, we are actually talking about only private equity firms that, as we will show you later, are firms that invest in late-stage companies, older firms, let's say. Anyway, let's give you some more background on different types of firms. So first, we show you the funding and investment cycle. So how does a venture capital or a private equity fund work? So as you can see in the top, you have investor 1, 2, 3, and 4. So a number of investors will pool their capital and give it to a venture capital fund. These type of investors can be pension funds, banks, wealthy individuals, insurance firms, you name it. Anyone can invest in a venture capital fund as long as usually they have a little bit of capital. I would say the minimum to invest is probably $500,000 US. Well, of course, if it's a smaller venture capital firm with maybe a fund of $10 million, of course, they will also accept smaller investments. But usually, you need to have a reasonable amount of capital to be able to access a venture capital fund. The fund will be managed by fund managers, which will make the decisions on daily investments and strategy of the firm. The investors are called limited partners. The fund manager is called general partner. Once a fund has raised all its capital, it will invest in all the companies. So you can see to the right, you have the investment cycle. So first there's a fundraising, then there's investment. So once the fund has raised all its capital, usually for the first 5 years, they will invest in all the different companies. And then for the following 5 years, since the fund is usually has a finite life of 10 years, sometimes they are extended to 12 years. These 10 years are divided in 5 years of investments, then the following 5 years of realization, which means that they need to exit their companies. So they need to sell their equity stake in company 1, for example, to either another venture capital firm or to a large company through merger or acquisition, maybe also to IPOs, initial public offering in the stock market. In any case, they need to exit the company. Either the company goes bankrupt, or if the company is successful, they need to sell their stake to someone else, hopefully at a higher price so that they can pocket the difference. The venture capital fund usually is compensated in 2 ways, which are called 220, which means I usually get 2% to run the firm of the capital they're managing. So if a firm is managing 100 million, they will get 2 million a year to invest and cover the daily expenses, the day-to-day operations. And the 20 is the 20% share of profits. So let's say if they manage to return to their investors 200 million, so twice as much as the initial capital, they will retain 20% of the 100 million profits, so $20 million. This is how the venture capital firms, as well as private equity firms, are managed and are run, and they are compensated for their work. So if we start from venture capitalists, there are two main categories of venture capitalists. On the left, you have institutional firms, which are independent firms, basically the model I've just explained before, but you can also have corporate venture capitalists. And these are subsidiaries of large companies. More or less all the big tech companies have some sort of corporate VCs. I can think about Apple, Intel, Google. All these large companies have a subsidiary that invest in startups, in technology companies. And this is usually useful to access new firms, access new technologies, sometimes establish partnerships, to have a foot on the market for new technologies coming to the market. So their objectives might be a little bit different compared to institutional firms. Of course, they want to have a return on investment, but they also want to have, again, some sort of sense of where the market, the technologies are going in their industry. The source of funds also obviously differs. In terms of institutional firms, they, again, get institutional investors, external money, while corporate venture capitalists, they invest the funds from their corporation. So when, in the case of Intel, for example, the venture capital arm will receive capital from Intel itself. The typical investment might also vary. Venture capitalists, of course, they have a broad range. They can invest between anything between 500,000 to even billions in this case. So there's been an increase in size in terms of investment size, but they're usually smaller. On the other hand, corporate VCs, they have more capital, so they can invest between $1 million and $2 million, $20 million. Please bear in mind that these figures are focused on the New Zealand market. If you look at the US markets, you can probably multiply by 10, maybe more times. So venture capitalists invest maybe between 2-3 million up to hundreds of billions of dollars. The monitoring also differs. Actually, it doesn't differ. So in both cases, you have formal control, and this means that they want to keep an eye on their investment. So when we look at private equity, this it works in a very similar way compared to venture capital, but it's bigger. So venture capital firms usually invest in early stage to growth stage companies, while private equity companies invest in late stage companies. So the startups are not anymore startups, maybe they have 5, 10 years or longer life. While venture capital firms might invest in startups between 1 year and, let's say, 3-5 years of age. In New Zealand, the typical investment is between 10 million and 60 million New Zealand dollars, while when you look at the US market, it ranges from 20 million to many billions of dollars, can also be $10 billion investments. They tend to invest, again, in late-stage companies that already have products, they have customers, and they have revenues. That, again, can range between anywhere between 30 million and $200 million. So these are established companies with businesses, solid businesses that have been growing for a number of years. They can invest for many reasons. For example, a company might want to grow further, maybe expand internationally. They might want to acquire another company, and they require capital to do so. In some cases, they also be funding the companies to go through an IPO or trade sale, and so they might need some sort of mezzanine investment to bridge the gap between the funding they have and then the funding that they need to reach an IPO stage. This is a slide from 2014, but it's probably still very representative, and it shows you the share of venture capital invested around the world. You can see that the United States is still a dominant player, but you can see that other countries such as the United Kingdom, Israel is a very peculiar example. It's a small country with a solid venture capital market. So you can see that the US is the dominant player, but venture capital is well spread around the world. And it also varies in terms of period, can be very volatile. You can see in the first red circle in 2000, there was a significant spike in venture capital investments, and this was because of the dot-com bubble, so there was a lot of investments in internet companies. You can see that in 2008 and 2009, there has been a significant decline, although it doesn't look very big, but in proportion is quite significant. this was because of the financial crisis. Then you can see that in the last 7 years, there's been a strong pickup in terms of investments. The reason for this is because there is just abundance of capital all around the world. Opportunities are scarce, government bonds are not returning any money, and so pension funds, banks, they try to invest their capital in venture capital firms in order to obtain better investments, potential investments that are uncorrelated with the stock market. Because of course, if you have a startup, it's a new technology, this company will probably be successful even with a recession, even with a stock market downturn. And again, bear in mind that these investments are 5 to 10 years, a 5 to 10 years time horizon. So if there's a stock market crash for 2-3 years, these companies will probably be growing, and in the future they will be successful. In the current situation with the coronavirus decline, it might be that venture capital investments will dry up significantly. There's been also other events. You might have heard of the SoftBank Venture Capital Fund, with the WeWork decline in valuation. All these big shocks also play a role in the venture capital market that, again, can be quite volatile in terms of investments. And probably in 2020 to 21, there will be a decline in the amount of capital available to startups. Regardless of volatility, most of the successful tech companies that you see around the world today have been funded through private equity and venture capital. Famous cases are Google, Amazon, Facebook. You might have heard recently of Snapchat, Salesforce. Everyone is watching Netflix, using Uber. All these companies have been financed through venture capital. So it's an important source of capital for growth companies to bring new technologies to market, because these companies are very high risk and banks sometimes are not willing to lend. So having risk capital available, patient capital, is important to develop new technology, solid companies for the future. And this slide is probably a few years old, so some of the valuation might have changed, but it gives you a general overview of the valuation and companies that have been funded through private equity and venture capital. At the top, you have Facebook, but even Amazon and Apple, which are now $1 trillion companies, they were funded through venture capital. In the second tier, the first tier, you also have Alibaba, which is a very famous Chinese company. The second tier, you have Uber, LinkedIn, WhatsApp, which have now been acquired by Facebook, LinkedIn, acquired by Microsoft, which by itself was also funded through venture capital, and so on. So remember, valuation might have changed a little bit, but you can see that more or less every tech company that we are using today has been funded by venture capital firms. So how does it work? If you want to raise venture capital, what is the type of process you need to go through? So of course, the first process is that you submit a business plan to a firm, to a venture capital firm. And usually they have either a website, so you can send an email, or even better, you try to get an introduction through someone who is in contact both with yourself and the venture capital firm, and you propose that you want an investment and you send your business plan. The first thing that venture capitalists do is the initial screening. This is a very, very quick operation that usually lasts, let's say, 5 minutes, so very short. They look at your business plan, your presentation, and they try to understand whether it fits with their investment criteria or interest. This means that if you are submitting a business plan for a biotech drug to a company that usually invests in IT, they're probably not going to be interested. So they look whether you are in the right industry at the right stage. They might also look a little bit further, but usually this is a stage 2. So if there is a fit in terms of industry and stage, they move on to the second stage. And this is probably a 10 minutes exercise, 15 minutes exercise. They skim through your business plan very quickly, and they try to get a sense of whether they're interested, whether what you're saying makes sense, the amount of capital you're looking for is in line with what they can invest. So 10 minutes to get a deeper sense of who you are and whether they think it makes sense. Stage 3 starts to be more serious. At this stage, you are invited for a presentation in the venture capital firm office, and these usually run between, let's say, 20 minutes and 1 hour. You will implement a presentation of, let's say, 10 minutes, and the second part will be Q&A. You can look at another video I made on how to present to investors to get a sense of what you should do. So in this case, again, there is both your presentation, 10 minutes, and then the Q&A can range from 5 minutes if they're not interested to maybe another hour if they're interested. If they're interested, they will move to the last stage, which is the final evaluation. So at this stage, they will do the due diligence. They will talk to your suppliers, to your customers. They will start to draft a contract for you, so also called term sheet. And then if all this goes well, then they will invest in your company. These stages usually take a lot of time. So even if you are successful and this investor is interested, you're probably looking at 1 to 3 months time. And for the entire fundraising, it usually takes 1 year, because obviously not every venture capital will be interested. Usually they don't reply immediately. So it's a very long and time-consuming, energy-consuming process. This is another example of the investment process. This is a case I've taken from a South American venture capital fund, and you can take a look, you can pause the video. Basically what they are saying is exactly what we have shown in the previous slide. You sign the opportunity, you do a pitch, and then they do analysis, soft and then hard. The investment committee meets, further due diligence, and then closing. And at the bottom, you can also see the expected timeline. And so you can see that each step takes a few weeks. And so overall, again, we are probably looking at a 3 months to 4 months timeline for the process from start to closing. So what are the main criteria, the main categories that venture capital firms are looking when they screen a proposal? You can see that the first 2 criteria are about the entrepreneur. So they want someone who is experienced, but also that has a good personality. Both someone resilient that can take a company from nothing to a successful company and potentially through a lot of failures, but also they want someone who they can work with, they can have a good feeling, that they think they will be a nice person to work with, a sort of long-term relationship. Then, of course, I look at the product or the service. Is it a good product? Is it a good service? And then also the market. Does the market need this product? Is it a growing market? Is there a lot of players in the market? Can we compete? And then, of course, I look at financial considerations. In short, can this company make money in the long term? This slide is an interesting slide because it gives you a ranking of all the things that the venture capitalists are looking in a proposal. And also it compares it to the New Zealand ranking. So here you can see you have the New Zealand rank, and then here you have the US rank. They are more or less overlapping, so there is not huge differences. And with the red arrows here, I'm pointing you out to, again, how important is the entrepreneur and the team. You can see for both New Zealand investors as well as US investors, let me try to move the video a little bit. For both type of investors, the trustworthiness of the entrepreneur is very important. You can see that it is number 1 here, number 3 here, number 2, and number 1 for New Zealand and US. So investors want to invest in someone they can trust, someone with experience, with enthusiasm, here with expertise, and someone they generally like. So someone they have a good relationship with. Of course, expected returns are very important, future growth potential of the venture is very important, and so on. It's very hard to raise venture capital. So overall, you will have a lot of things you need to keep in mind and a lot of boxes you need to tick for the investors to be interested in your company. But being a good entrepreneur already helps to get funding. Here is another slide taken from an academic research. Again, tells you more or less the same things. What are the screening criteria, the venture capital firm requirements, or are you meeting the basic requirements, investment size, age of the company, industry. So very basic fit between the venture capital and the firm. the economic environment, so the industry, is it a good industry? Is there long-term growth? Does your strategy make sense? Is the product a good product? Is the entrepreneur and the team someone I like, someone I can trust, someone with experience? And finally, are the financial projection realistic? This is obviously very relevant for the topics we will be covering in the next slides, in the next course, in the next classes. Usually entrepreneurs are wildly optimistic. It's important that your projections make sense and they are backed by research and good findings, good reasoning. Otherwise, it would just look weird and unreasonable to the investor. Overall, what these classes, as explained us, is that venture capitalists, they have a lot of criteria, they look at a lot of things, but they usually want to invest in an entrepreneur that can ride the firm to the next level. So hopefully you have enjoyed this class and it has been useful to you. I look forward to the next class.